Vanguard's very, very pessimistic future return projections. Yeah. So I love using the Vanguard Capital Markets model, VCMM. Every year it comes out. Every year I like it. And like any model that projects it, everyone's going to shoot darts at you because you're never going to be right, man. I mean, other than freaking, what's his name, Shiller, and who published his book, Irrational Exuberance, in March of 2000. It's just luck because he had been working on that book for many years previous. You're always going to be wrong. And when you're wrong, everyone hates you for some reason. And Vanguard has been significantly wrong on the underside. So basically, they've been well more pessimistic than what the markets have shown. I don't care because the reason that I like it is because they're fundamentally right. I'm just going to skip to the chase. I'd done this video before. I said, yeah, I'm too deep in the weeds. We're going to bring it back. I'm just going to show you what they say. And you can read this for yourself. Link in the show notes. All right. So here's Vanguard. All right. Valuation contraction. Contraction in the U.S. is expected to drive excess returns internationally over the next 10 years. So what that means, I don't care about the international. We're just going to talk about the U.S. Vanguard expects earnings growth and dividends to give a 6.5% rate of return, but valuation contraction, i.e. people getting, more negative on the stock market than positive, will take away 3.2%. So let me show you how this works. I could not disagree with this more. I mean, they might be right. I don't know. But how Bogle, Professor John Bogle, RIP, who founded Vanguard, in his books, you can get back there. Well, you can't get my books, but you can get your own. Define future stock performance. I could not agree more. He says earnings growth, e.g. year over year, plus dividend yield, all right, equals your fundamental rate of return. And so I always use a 4.5% earnings growth year over year plus a 2% dividend yield. And when I say always, it's subject to change. All right, so that's what I use. So I use 4.5% earnings growth year over year plus a 2% dividend yield, and I get a gross 6.5% rate of return on stocks. Vanguard is using 5 plus 1.5, and they are also getting, just like me, a 6.5% future rate of return on stocks for the next 10 years, fundamentally. But Vanguard uses what they think is a valuation change, a contraction. The PE ratio is dropping. I'll share with you why they do that here in just a second. So they think you're going to get 6.5, but because people are more bearish, i.e. net sellers and buyers, you're going to lose half of that 6.5% rate of return because the price to earnings ratios are declining. So remember, price to earnings ratio is going up. It means you have more valuation of your stocks relative to earnings. Price to ratio, PE ratios go down means you have less valuation of stocks relative to earnings. It's just a matter of what you are willing to pay for $1 of earnings. So if you're willing to pay 20 for $1 of earnings, you have a PE ratio of 20. So here we go. PE ratio is how much you're willing to pay for $1 of earnings. If you're willing to pay 20, you got over $1 of earnings, that's a PE of 20. If you're willing to pay 25 for $1 of earnings, that's a PE ratio of what? Of 25. All right. So what Vanguard would say for folks who are willing to pay 25 as opposed to 20, that's a what is that? A 4 divided by 20 is a is that 24 divided by 20? That's a 20% increase in PE or price, price increase. Because I'm willing to pay 25. That means I have more positivity in terms of what I'm willing to pay for. It doesn't make any sense. If I'm willing to pay 25, I'm willing to pay 20% more than 20 as a PE, which means it's not price contraction, it's price acceleration because I'm willing to pay more for $1 of earnings. I hope that makes sense. But Vanguard, on the other hand, is saying, look, if the natural PE ratio is 20, all right, you got 20 PE, but people are only willing to pay 17. That means you have a price contraction of 17, hold on a second, 3 divided by 20 of 15%. Because if the natural price to earnings ratio is 20, but I'm only willing to pay 17, a la the 1980s, early 80s, late 70s, that means the prices must go down. There's a price contraction, and that's what Vanguard expects to happen. They expect, because the PE ratios are too high, too frothy, that they're going to come back down to normal. And I completely disagree with that. So anyway, that's what I hope that explains. It probably does, but I hope that explains it. So I use a earnings growth of 4.5 plus a 2% dividend yield. I get 6.5% total return. I don't use valuation changes because that's purely speculative. And they have this model. I don't even care what the stupid model says. 3.2% valuation change. I'll tell you why. I just completely disagree. Now they think international returns are going to give you twice what the domestic. They've been saying that for years. At one point they'll be right. I don't. I mean, they might be right. I have no international stocks. All right, now remember, this is gross before inflation. All right, so then we go to, I think it was 22. We go to page 22 right here. These factors contribute to our expectations that inflation will stay elevated for some time before slowing the second half, bringing the CPI index in the range of 2.5 to 2.3 to 2.6 year over year. All right, not just for the end of 2022, year over year. So it looks like they're saying they think inflation is going to be 2.5%. So if we go back to what we just saw, here, 3.3% rate total return gross, and they're taking out 2.5% inflation, they think your real return is going to be 80 bips, 0.8%. I mean, that's less than 1% real return. You still got to pay taxes on some of this stuff too, especially if it's on an IRA. So essentially, Vanguard is basically saying you're just going to break a little bit more than break even in stocks. Now, here's the problem. If that were to happen, people are going to say, why in God's name would I have stocks with all the risk? I can just go over here and basically make nothing, just lose a little bit in bonds, which are fixed. And that's, I think, the problem Vanguard has. I think a lot of people do as well. So let me show you why. So we're going to go up to here real quick. U.S. valuations are being stretched at the highest levels since the early 2000s. Hey, buddy. And if any of you are familiar with my YouTube channel, I certainly hope you are, where you've been. They're going to use this based on Shiller's CAPE ratio. the cyclically adjusted PE ratio. I've been hearing about the CAPE ratio for, 15 years now. And it drives me crazy. All right, so anyway, U.S. equity. So here's the CAPE. CAPE for the S&P 500 index, historical average. So basically, the historical CAPE for the S&P, the historical average is 20. All right, cyclically adjusted PE ratio. All right, that means they're spreading it over not just today, because I agree with the need for the CAPE, but I don't agree how it's being interpreted, and I'm going to share with you why here in just a second. Cyclically adjusted price to earnings ratio basically it takes off the anomalies like we had in March of 2020, where all of a sudden stocks are trading like a PE of 6. And the reason was because they were using last year's earnings versus the current price, and that's silly. That's an anomaly, and you don't need to get too deep in the weeds there. So what the CAPE does is they try to stretch those anomalies out to reduce their impact on current PEs. However, you'll see right here, the CAPE for the S&P 500 right now is at, 40, which is the highest it's been since the dot-com bubble. But the funny thing is we've heard that a million times. Look, the highest has been since the dot-com bubble. Look, highest has been since the dot-com bubble. We've heard this 1,000 times a Sunday. We always hear this. It's been like that for freaking, like I said, 15 years. Read my man Ed Easterling, and I love the guy, but they've been talking about this, the highest it's, Asness, what's the guy's name? Asness over at the AQR. I'm not sure if they were all that. Anyway, Ed Easterling had written all kinds of books and charts. I forgot where he was with. I'm drawing a blank. I got one of his books back there too. Talk about the CAPE being the highest since the dot-com bubble, right in here. And he published a book in 2011 showing that. And here we are, the highest since the dot-com bubble. So what happens is, oh my goodness, the highest since the dot-com bubble, crash! Oh my goodness, the highest since the dot-com bubble, crash. And they said, yeah, what happened here? That's the highest since the dot-com bubble too. What happened here? The highest since the dot-com bubble too. Highest since the dot-com bubble too. Crash. What caused the crash? It wasn't the CAPE being high, and here we are here. So look, we're always going to have a bear market for heaven's sake, but just the idea that's the high, it's like, I'm not buying stocks. They're higher. They're more expensive than they ever been. More expensive than what? Earnings. Okay, well, that's what this shows. Well, they're also the highest valuations we have ever been. Well, have you ever looked at the stock chart? It goes like this. It goes up and down, up and down, up and down. The gains are permanent. The declines are temporary. Will that continue on? I have no idea, but I'm full throttle believing that it will. So you got it like this. Shoops, 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 shoops. Gains are permanent. Losses are temporary. I hate that. Well, the stock market's trading at the highest amount it's ever traded. Yeah, well, welcome to the world. It was in 1982. Well, not 1982. Well, maybe it was in 82, but certainly was in 1988. Certainly was in 1994. Certainly was in 1999, and so on and so on. All right. The point being here is just because of CAPE, but here's the issue: the CAPE has historically been at 20. All right. Now, what's the difference between the dot-com bubble and now? Anyone want to take a guess? Anyone want to take a guess what the CAPE is and why Shiller has adjusted his CAPE as well? All right, let's take a look at our trusty phone here, and we're just going to see, boink, boink. Oh, I tell you, no, we won't even look at that. We're going to show you something else. Hold on a sec. Now you get a 30-year Treasury trading at 2.12. That's a yield to lock up your money for Treasury bonds, 2.12. Vanguard projections of inflation being about 2.5 means you're losing money without even paying taxes, and you still got to pay income tax. All right, the 10-year is 1.81. All right, so let's go back, shall we, to, I don't think it goes back to 1980. Well, we'll go back to 2000. The dot, well, let's go back to 2000. And let's see what we're looking at here. What is that one right there? Looks like oh, yeah. All right, cool. So, they got the chart right now, historical. Oh, cool. They used to not have that. We'll go back to 2000. I want to come back to that because that's pretty neat. All right, so let's go back to 2000, and that we're on February 2nd, right? Groundhog Day. So Groundhog Day of 2000, the year 2000, 30 years at 6.32. The 10 years at 6. The 10 years at 30 years 6.32. The 10 years at 6.6. Yeah, 300% higher. 300% higher. So when you have a CAPE with a 10-year at 6.6, and now we got a CAPE with a 10-year at freaking the 30 years at 2.1, and the 10 years at what the hell is the 10-year at? Freaking 1.8, 1.76. I mean, it's actually more than 300%. It's almost 400% because we got 6.6 divided by 1.76. That's 375 basis points higher. Remember, you don't invest in a vacuum. You invest, like, what could I put my money here today versus other things? Should I pay off my mortgage? Should I buy a bond? Should I buy some real estate? Should I buy this stock versus that stock? It's not a vacuum. There's all these alternative competing investments that you have to contend with. So you're saying, I could buy a 30-year Treasury bond, get all of 2.12%, or a 10-year Treasury bond and get all of 1.766. However, my inflationary expectations are much higher than that, 2.5 at the very minimum, according to Vanguard. It could be higher for sure. And as such, I'm going to lose money on locking my money up for 30 years or 10 years. That does not make bonds look very attractive now, does it? So what I'm going to do, I'm going to buy some stocks. Yes, they are highly valued, but I'm still getting a 2% dividend yield. All right, and there's still earnings growth year over year, positive earnings growth. I'm willing to freaking buy stocks at a higher PE because the bond rates are so low. And Shiller adjusted for it. I think he called it a CAPE. I think CAPE interest. We'll have to revisit that in a different video. All right, so this is what I don't understand. How come people don't understand this? Anyway, so you can drives me up the wall. All right, so actually, I do want to see something. Just what I'm thinking about here. Where is the right there daily yield curve? Is that a new? Oops, is that a new chart they got there? Historic Treasury rate chart. Let's take a look. I'm not familiar with what that looks like. This visualization displays long-term rate. I have to have Adobe Flash Player. I guess I don't, because I got a MacBook. I'm too poor. All right. Anyway, that's all right. So anyway, let's keep going. So I want to show you something else here too. So Vanguard, U.S. value, they're big on value relative to growth. So they think growth is going to give you basically 1 or 10 basis points on the median. Median means 50% higher, 50% lower. They think value, their median is 4.1. I am heavy in the value. I actually agree with that. 100% agree with that. I mean, we could be wrong, but the issue is people will pay for dividends more than they'll pay for just earnings. Growth is just based on earnings projections going forward, which may or may not come to fruition. Value is based on actual hard dollars, the dividends that you receive. And value is underperformed relative to the growth for basically the last 5, mostly 5, but certainly the last 10 as well. So anyway, that's what you see, 4.1 to 0.1. So if we had a 4.1% value minus 2.5% inflation, we're still making 1.6. On the other hand, growth at 0.1 minus 2.5 inflation, you're getting a negative 2.4 year over year. Who knows, man? Who knows? Growth volatility is 17.5, value is 19.2. That's what I show in my projections as well. I want to show you something else here too. And they're big on global They think the median global will be 6.2. You know, they could be right. We've been hearing this for years and years and years. I don't trust foreign markets, not in the least, not as far as I could kick them. You do you. I'm not touching it. 11 and 2 and 11.2b show that U.S. equities have outperformed our forecasts, pushing our return expectations lower, while international equities have underperformed, pushing expectations higher. All right. So they're going to say, why? Why did that happen, Josh? Why? Investor psychology and higher earnings explain most of the error in our forecast. All right. So investor psychology, basically, people are dumb. They're paying too much for $1 of earnings. But this is the same thing happened with Shiller. Investor psychology isn't stupid. Investor psychology says, look, why would I pay? Why would I lock in my money for 10 or 30 years at a corporate bond which has risk and not make any money after taxes and inflation? Why not just buy a stock that is going to give me volatility? I get that, but even if the PE ratios are higher, what's Nick Murray called? The inverted PE. I think it's the inverted PE ratio relative to the treasury yields. I can't remember what it's called, but it's very interesting. I completely subscribe to that theory. All right, so here's their 10 years. So this is from 2011. They expected inflation to be about 1.6. All right. They expected the PE change to be -1. So, oh, wait one second. Okay, here we go. So they expect, what's this on? I can't tell. This is confusing. Oh, here it is. All right, so they expected the valuation of price to earnings ratio to only be flat, that people would not be willing to pay more for $1 of earnings than what actually happened. In fact, what happened was people were willing to pay 6.4% higher. So if you had a 20 PE back then, you're willing to pay 6.4% more for that $1 of earnings. I hope that makes sense. They didn't expect that. They didn't expect any change in that. So you have 10-year yields -0 or 0. You have 1.6% inflation, 6.4% annualized behavior, they should say, which meant basically what's that? That was a big right here. 7.9% is what the actual change in valuation was. 7.9%, and they didn't think it'd be anywhere near that. They thought it'd be -0.1. All right, so they were way off there. Earnings growth was 5. What their expectations, dividend yield was 2.5. Their total return, this is from 2011, was 7.5. They were less than half of what the actual rates were. Earnings growth were 7. Dividends were lower. Dividend yield because the stocks are going up. And then total return was much, much higher. And again, the total return was only 9% fundamentally. The rest was based on investor psychology. People willing to pay $1 for earnings, more for $1 for earnings than what Vanguard anticipated. All right, so the point being is, it doesn't take a rocket science to this is why I don't understand these people using the CAPE so much. Let me find, hold on a second. Here's a headline from Fortune. Shiller's CAPE just hit an alarming new high. You see this all the time. So here's, again, another, this is Yahoo. They say Goldman Sachs has destroyed the CAPE index. And you can read that. I don't care. But the reason is a simple Google search for CAPE will return years of articles about how the market is about to crash. And as you can see, it's being talked about now. Stocks have a bump. The whole thing is just freaking dumb. I'm sick of that crap. But this is even stupid because they're saying Goldman Sachs there is no mean reversion that any statistical probability. And okay, that's not even what I'm looking for. I'm looking for the fact that interest rates are so low. I find the article specifically, but hey. I can't find the article specifically, but I'll put a link in the show notes for a video I did in December 2020, how Robert Shiller was making sense of sky-high market prices. And, lo and behold, in 2021 is higher because it's up 35% or something like that, the S&P 500. Can't remember exactly what that was. It's in Advisor Perspectives or something like that. But he's adjusted his CAPE, or at least talked about it, when debating with Jeremy Siegel, because the CAPE did not take interest rates into account. So whenever you hear these CAPE ratios, oh my goodness, run for the hills. Then what's the alternative? A 30-year bond at 2 when inflation is 2.5? That doesn't make any sense, man. That doesn't mean you go all stocks. Here's what I'm doing. VTV, baby. And again, if you're retired, you should probably back up and do some Wellington. I got VTV. For me, it's VTV or bust. VTV forever. I get that tattooed on my chest. VTV. All right, we'll see you guys. Love your thoughts.